So yeah, this is it. You can almost trade frequently with this way of trading. So for a market going upwards, you take your trade line to and you start tracing the market upwards in the 1 hour time frame. I use 1 hour time frame. You get to see certain things. So what you are basically doing by activating your trend line tool is not to draw your line, the uptrend line like this. No, you are looking for when the market would break downwards with the volume. The keyword is volume. Say after me, volume, volume. Say after me again, volume, volume. So the thing is, whilst when you activate your trend line tool, you are looking for a place where the market will come downwards with the volume, and before it comes down with the volume, it must had created another block. And if you are a trader that knows other block as a an engulfing candlestick, then you should know that I'm referring to an engulfing candlestick, a bearish engulfing candlestick like this. Bearish engulfing candlestick. This is bearish engulfing candlestick, right? Then this is bullish engulfing candlestick. So yeah. So you are looking for so when you activate your trend line tool, you are tracing it. So you can just put your hand like this and you are moving. As the market is going upwards, you are moving your hand. You are saying, okay, there has not been a voluminous break yet. You are moving. You are moving. You are moving like this. You're moving like this. So in this place now, this is volume actually. But is there another block that was created before the voluminous break? Was there another block here before the voluminous break? No. So that's invalid. So keep on looking. You keep on looking. So because you have to actually do it as like in real time. So keep on looking for a voluminous break. So yeah, there's voluminous break here, and before the voluminous break, there's another block. Perfect. A bearish engulfing candlestick. Good. Let me speak like Mr. PFS. So in this particular Vomulus move now downwards, you look for the center of it, of the Vomulus move downwards, the Vomulus break that first created another block, and then you put your trend line at the center of it like this. And I don't even know what even happened at the right hand side. I don't. But I knew, but I've forgotten as at this moment. So I'm putting it here. This center. So from here to here, this should be the center. So just extend it. I wish there was a way to put that as an array, as a ray. There must be, yes, ray to the right. Yeah, so that it extends far beyond. So yeah. So look at this. Look at this. Look at the Vomulus break, and there's another block. So you mark that other block. You mark it, and then look what happened when the market came downwards. The market is supposed to go back to that other block and tap it. And look at if the market should go back upward to tap into that other block, what else would it be tapping into? The line, the trend line that was broken out of by the market price. So this will be a retest. And when the retest happens, you target something, you target wherever you want to target liquidity. But let's keep on going. So the market has broken downwards below the line. And then you see something here. Liquidity was created here. There's liquidity above. There's liquidity above here. Liquidity here. Liquidity here. So we are expecting the market to go upwards. So when the market goes upward, what will it do first? It will take out the liquidity here first, and then it will go upwards, tap into this other block. Now remember, the Vomulus move that happens, that breaks through the line, must have created another block first, which is a bearish engulfing candlestick. That's number one. So when it taps into the other block, you go to the 5 minutes time frame. You go to the 5 minute time frame. So before it even taps it goes into the other block, your zone of interest. Before it goes there, you go into the other block. in the 5 minutes time frame, that's the other block you drew, you marked in the 1 hour time frame, you go to the 5 minutes time frame, and then you locate that zone in the 5 minutes time frame, which is this now. And then you look for another block inside the zone, and you make use of the highest other block. So if you see another block inside the zone, the 5 minutes time frame, let's say you see two other blocks, you see one here and you see one here, you make use of the highest. Always make use of the highest, and don't use the limit, because market price can break through it and then later come down. So we'll get to that very soon. So in this case now, we are not seeing another block. Because we're not seeing another block, we would make use of this. But probably I would even make use of this the highest point here. I'll make use of this body. So how are you going to make use of this? If we're making use of this, you put your horizontal line at the center of this black candlestick. At the center of the black candlestick. But I'm not going to make use of that. I'm going to make use of this body. So I'm going to put my horizontal line at the center of it. So I'll just simply take my horizontal line to put it at the center. So I'll be waiting for price. I'll be waiting for price to come to this other block zone in 1 hour time frame, and then let's say form a particular confirmation candlestick or form another block. So it can get here and then form another block, that's a bearish engulfing candlestick. Another block is a bearish engulfing candlestick. So when it gets here, it taps into this line, you should expect to see a bearish engulfing candlestick, and that's another block after it taps into this line. In some cases, you can see that it would come to this line, break through it. When it breaks through it, you should not be panic. You should not panic. You should not be in panic. You would wait for the market price to come back into the line and close below it, and then you look for another block. In some cases, it might be in some cases that the move that would the particular move that would take the market price downwards to close below the line would be another block. So if it's another block, that's your entry. You take your entry and you put your stop loss above the other block. So for the particular move now, we are waiting for the market price to tap into that other block. This is supposed to go perfectly well. So let's go to another one, another asset, volatility index. This is something that one would have traded, but I'll simply close this trade. Let me close this trade. It was already in profit previously. This is the demo account. So look at this. The market was going upwards. The market was going upwards. The market was going. Okay, let me first of all remove it. Remove ray. First of all, remove ray. So the market was going upwards. So as it's going upwards, you are trying to look for where is the Romulus break, and in that Romulus break was other block initially created, or a bearish engulfing candlestick. So you are following the market. Okay, this was a Romulus break, if you want to be sincere. But then if you observe, this looks also like a consolidation. So careful now. So probably we would have ignored that. Keep on looking for a Romulus break. Yes, a Romulus break. Then you put the line at the center of this. So this, you always put the trend line at the center of the Romulus move downwards, the Romulus break, the center. So the center of here is what? Here. So look at this. Before the Romulus break, the Romulus move happened to the downside. What happened? Another block was created. A bearish engulfing candlestick. As you can see, a bearish engulfing candlestick was created. So at the point where the market now, when the break happens like this, Romulus move happens like this, it has to be something like this. The market comes downwards and then you see it tap into it. It has to be something like a V shape. Not that you be seeing something like it will be as though it's consolidating on that particular line, something like this, to be as though it's consolidating on that particular line. No, it has to be a V shape. Market breaks downwards and then goes back upwards in V shape. So in this case now, let's say the market was at this point. We would have then gone to the 5 minutes time frame. to look for entry. So we would have, what are we looking at for here in the family type? We are looking for another block, and here is the other, here's another block, and before the other block there was another block below. There was another block below this, but we always make use of what? The highest order block. So we would have made use of this highest order block. And since we are dealing with order block now, when you are dealing with order block, you put the horizontal line at the center of the smallest order block. So at the center of the smallest candlestick of the bearish engulfing candlestick. So this is a bearish engulfing candlestick. So this is the smallest candlestick. The smallest candlestick there, you put the horizontal line at the center of it. So you put the center line, you put the horizontal line at the center of the smallest candlestick of the other block. All right. But if we're making use of just a normal candlestick, we probably would not see another block or a bearish engulfing candlestick. We're making use of this candlestick. Would have put the horizontal line at the center of the black candlestick, the center, right? So we are seeing another block. So put our line there. So let's go to the right hand side and see what happened. Look, the market tapped into it, and then probably at the point as the market moved into the line as bullish candlestick, we would have waited for it to close below. So as you can see, it closed below with this bearish candlestick, this black candlestick. Then it then created another block. That would have been your entry. That would have been your entry. You would have put that would have been your entry. Enter here, put SL just above the other block right here. They target liquidity where liquidity is in the 5 minutes time frame. So this is where liquidity is in the 5 minutes time frame. So I would have not put it here. Actually, I would have put it here. I would have put it here if I want to be sincere with you, above the other block, just to avoid mistake. But another thing that another reason why you would have been able to put it here is this. Why would you have been able to why would you have had the mind to put it here? Because there is something like a W pattern here, W pattern. And if there's a W pattern, it means that there's all likelihood that the market will tap here, tap into that line. So, but see, there's another block there. I would like to always put my TP above the other block and to avoid mistake. So you can always open two trades. You can always open two trades, so that one is for you to make small profit and the other one for you to make higher profit when you are using this strategy to trade. So I think the other one is 25 volatility 25 index, or what is it that? So so this is volatility 10 ones. So let's see. We are moving from here. Market is moving upwards. So we are following, looking for a voluminous move. There's no voluminous move here, of course. This is consolidation. Voluminous move must be all bearish candlestick moving downwards. Bearish, voluminous move. Not that you see bearish, you see bullish, you see bearish, you see bullish. No, that's not voluminous move downwards. That's not a voluminous break. It has to be a voluminous break. And there is something that you might note, that when it's a voluminous break or bearish, and another block was formed before the another block another block was formed before the voluminous break. Because it's a voluminous break, the break happened with consistent bearish candlesticks. It happened with volume. That might be the reason why when the market goes back to that other block zone, it will not go above that other block zone. It will just enter. The zone would contain it. It would capture. It would arrest the move perfectly. That might not, it might not always be the case. So keep on moving. There's no voluminous break yet. Keep on moving, and boom, there's a voluminous break here. So this should be the center. This should be the center. So before, this should be the center. This from year to year now, this should be the center, right? So let's put it here. So just before I even go on to check what's happening on the right hand side, although I've already done this before, but just before we go, let me show you. Look what happened at the center when I put it at the right center. Did you see this? Did you see that precision? So now you check the other block. Did he create other block before that Romulus can before the Romulus break? Did he create another block? Let's check. Yes, he did. Yeah, create another block here. Create another block here. So you you mark it. You mark the zone, and then you can even say there was liquidity here, sef, which as it came back up. This is very similar to the trade we are waiting for in volatility 50 index. This is very similar. The one I did it at first. So when it clears liquidity now to tap into this zone, then boom, we should expect a very good. Okay, let me not talk about that yet. Then after marking the zone in the 1 hour time frame, I always use 1 hour time frame. You then go to the 5 minutes time frame to look for entry. So you look for other block in that zone. So there is another block here. There's also another block here. You make use of the highest other block. You mark with horizontal line. You mark the smallest candlestick of the other block of the bearish engulfing candlestick, the smallest candlestick of that pattern, of that candlestick pattern. You put the horizontal line at the center of it, and then you go to the right hand side to wait for price to come to that point. To that point. And as you can see here, price came to that point. You can see the confluence, the line, even the trend line. So there's a zone there. There's also a line for retest. So you can see that the market went above the line. So at that moment, you would have waited for the market to come back in below the line, and the market came downwards below the line, and it came downwards and closed below the line as another block. So you would have entered there, put your stop loss just above. So the key thing here is Romulus break, and before the Romulus break, there has to be another block. So let me show you something here. So you can see, we would have entered here, put our stop loss just above, they targeted where there's liquidity. So where is there liquidity? There's liquidity here. We would have put our stop loss here, our TP here. So let me mark it. So look, would have reached what? Would have reached what? $3.14 to gain $32. And at this point, you had the opportunity at this point to open two positions, because you are risking a little amount to gain $32. You would have you had the opportunity to, or should I say, okay, if you were present at that moment when this thing was happening, you had the opportunity to open two positions, so that the one would be for short profit. Probably when it gets here, you take your first profit, and that first profit would have been what, like $14, and then the other one you'd have left it to give you $32. And let's see if it actually got to that TP. Let's see. It got there. So that's that. So this very useful for retail traders and smart money concept traders. It's a combination of both.